What a strange day we have here. We get a massive sell-off in gold. Stocks don't do anything. Crypto is moved and then not by a conversation from a Fed governor. Asset values going all over the place and very little rhyme or reason to discern, but we will try nevertheless. This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And what we are going to try to do here is take a look at the price action today and see if we can't make sense of what these markets did and why they did it. As we get ourselves together for what is finally a glimpse at real U.S. economic data. It's not coming up for a few days here, so we can maybe get ourselves together and have a conversation about why that data should or shouldn't matter. This is, of course, the eternal question for market watchers. That is to say, why does anyone need to look at economic data? Does the economy even matter for the markets? And of course, the short answer is the reason that we end up looking at economic data most of the time isn't to try to figure out what the markets will do with the economy and whether it's the economy that really matters as such, but really what we might get from the central bank as a response to the economy, which is why oftentimes we get these sort of confounding things. We're one to try to get a textbook understanding of what the markets are doing. And let's say you get inflation and the response to higher inflation is that the dollar goes up. And of course, that's not because inflation is good for the dollar. It's because the markets are looking past inflation as such for the implications of what the central bank will do with that information. That is to say, raise rates. And so we have a situation here where the tea leaves are starting to come together, and the outlook hasn't moved, but we do have some data on the horizon here that might finally get us a little bit of motion. So let's first and foremost take a look at what these markets did today. We have kind of a nothing day for stocks. The S&P ultimately doesn't end up going much of anywhere. The NASDAQ likewise ends up with a slight loss, but ultimately nothing much to look at. The 10-year off a little bit, so slightly lower rates. Bond markets making some headway today. No action at the front end of the curve. The 2-year basically unchanged here. Crude oil manages a little bit of a wiggle higher. It's not clear exactly what inspired crude oil today because there really wasn't much on the calendar to speak of by way of catalysts, but perhaps what we saw here was a little bit of a response to comments from U.S. President Donald Trump aimed at Hamas. They have been out there violating the terms of the ceasefire, according to the president, by rounding up and publicly executing some of the other fighters in the Gaza Strip that aren't Hamas affiliated, and that has apparently inspired the president's ire, and he posted on his media platform, his social media platform on Truth Social, that were Hamas to continue there would be consequences, and that other Arab nations that are U.S. allies have already offered to send in forces and quote unquote clean things up. So it's an interesting kind of a situation, and maybe the market allowed itself to think for a bit about oil disruption risk were there to be a wider conflict once again in the Middle East. But short of that, not really anything that's immediately jumping out as a catalyst for oil. And in any case, the moves here relatively modest. So it's not necessarily the case that we are even going to look at whatever this is as more than just jostling around some levels. Looking at what's really the standout here, of course, the sell-off in gold. Now, to put this in context, this 5% move is not the usual order of business for gold. This is a very large decline. The last time we had anything remotely adjacent to this was August of 2020, which nicely gives you a sense of just how tectonic of a move this is. This was right on the run-up to that year's Jackson Hole Symposium, where the Fed famously signaled that they are not going to go down the road of more expansive stimulus than cutting rates to zero and issuing unlimited or open-ended QE in March of that year in response to the COVID-19 pandemic. So we don't really have kind of near-term analogs. In fact, if we had to go before then for gold, we'd be looking at 2013 and the march toward the Fed's rate hike cycle that started in the wake of the '08 crisis and sort of its immediate aftermath. So we're looking at a situation here that's very unusual, to say the least. This could be just an unraveling of speculative froth. It does make a bit of sense that gold is down in an environment where the dollar is stronger. We can see the euro down about 0.4%. The yen really having the big move. It's off 0.8%. That's after the new Japanese prime minister managed to put together a coalition and actually got her spot. There was a vote in the Diet overnight here, daytime for Japan, where she was able to cultivate a coalition and was able to actually become the first female prime minister of Japan. And of course, her views have been quite dovish as a departure from the recent administration and as a departure from what the BOJ has been doing, the Bank of Japan. They've obviously been something of a standout on the major central bank stage. They've been raising rates, whereas everybody else has been cutting them. And so the news that she will, in fact, move forward, that she has become prime minister, that's weighing heavily on the yen here. Bitcoin up a touch. It was up quite a bit more, and we'll talk in a second as to why, but ultimately couldn't make it stick. So our barometers for risk sentiment, Bitcoin and stocks together, they ultimately don't continue after what was a pretty potent jump yesterday. So what did we get by way of news flow? Let's start with Bitcoin first. There was a speech from Fed Governor Chris Waller. He did not talk about monetary policy, so not much of a guidance there, but he did say that the Fed is studying payment accounts for firms that currently rely on third-party banks, which essentially just means for crypto banks and stablecoin banks, or things like this, and that the Fed is looking at making its payment rails open in a limited capacity for these non-bank entities. The conversation seems to be that accounts would have limited use of the Fed's services, but also receive streamlined review, and they wouldn't have access to interest payments. They wouldn't have access to overdraft privileges or the discount window for emergency lending. They may face balance caps, but nevertheless, this is the loudest endorsement yet of crypto as an asset class. The Fed essentially saying, look, we're going to let these companies clear directly with the Fed, albeit on some sort of a limited basis as relative to banks themselves. And not surprisingly, this was a pop for crypto, but Bitcoin ultimately doesn't get very far on it. There's a little bit of an uptick, as we saw, and it doesn't actually end up giving us anything lasting. Crypto ultimately ends up oscillating. Perhaps the markets looked at this and said, well, Chris Waller just really wants to be the next Fed chair, and so he knows he's talking to a crypto-friendly administration here and is perhaps looking to win some friends in the contest. See how that goes. Likewise, looking at sort of the barometer for sentiment here, the major indices, here was the big sell-off from the highs in October for the major indexes. And we can see that while the Russell, of course, has been much more buoyant and is now even holding on to a small gain, the two big indexes, the NASDAQ and the S&P, they've just managed to essentially return to neutral, but only that, only so much. We haven't actually seen follow through here on yesterday's big moves in broad terms. Now, in some ways, this makes sense. Fed policy expectations have been steady. We can see here we're still looking at 98-ish% chance that we're going to get a cut in October. That seems to be a given. Barely changed from yesterday, barely changed from a week ago, barely changed even from a month ago. The view for December still looking like a cut is already baked in there, also in the high 90s for the likelihood, not materially changed from yesterday or a week before, so we're fairly anchored here. And on the longer term outlook, not a whole lot going on. We can see we're anchoring around about 110 basis points here in rate cuts between the rest of this year and next. We're getting increasingly in the direction of more easing for next year, 72 basis points now on the menu. So the market is overwhelmingly looking for 3 cuts next year. Almost all of that is now baked in. The Fed still has 25 basis points on its bingo card for next year. And at least for now, the markets don't seem to be showing any kind of attempt to reconcile any of this. And that seems to be fine for now, which is an interesting set of circumstances, because what we're going to get here, again, coming up later this week, is going to be US CPI data. We'll talk about it in granular detail later this week. Suffice it to say, we're expecting for core inflation to hold at 3.1%, for headline to rise from the high twos up to 3.1%, which would be the highest since the first half of 2024. We'll see how that impacts things going forward. On the data front, so far this week, we've had Chinese GDP out. Disappointing numbers, 4.8%. That's versus 5.2% in the prior quarter, though it was broadly in line with expectations. We can see here that going now for quite some time, all the way back to the beginning of 2013 and the reopening of China for the COVID lockdowns, we see the economy is essentially in whole deflation mode. So for 9 consecutive quarters going into these GDP numbers, we've had real GDP running hotter than nominal, which of course means that the inflation adjustment that takes you from nominal to real is nominal minus inflation. And of course, if real is then above nominal, then what you're really looking at is nominal minus negative inflation. And we've been there for 9 consecutive quarters. Going into these numbers, we can see we don't quite have the publication of the nominal number yet, but it isn't difficult to figure out which way the wind is blowing here. This was the weakest GDP reading since mid-2024, the third quarter of 2024, as a matter of fact. So we're at the bottom of the range here for real GDP, going back to where the reopening from COVID occurs. Nominal seems unlikely to suddenly jump in this direction. And so we're probably looking at a 10th consecutive month where this spread between nominal and real is negative. And so we have essentially a near total absence of demand in China. We'll see how that impacts the negotiation that Donald Trump is getting ready to have with Xi Jinping. They're supposed to meet on the sidelines of the APEC conference in South Korea next week. The president confirmed it again today. But it doesn't look like these trade war headlines are really having a lasting impact on sentiment. Also on the Chinese side of things, retail sales slowing, the weakest now since basically last year, tail end of last year. That just tells you, again, no demand. And industrial production a little bit higher in year-on-year terms, 6.5%, but the trend we can see since the beginning of the year has been lower. So we've had these upswings, but the trend seems unmistakably pointed downward. We also had Canadian CPI data, inflation jumping to 2.4% year on year. That would be the highest since February, and not surprisingly, the Canadian dollar held up a little bit better against the greenback than did most of the other majors. As we said at the top of the show, were markets to look at this data at face value, you would think, oh, well, inflation should be bad for a currency's purchasing power. Shouldn't the currency go down? No, because the markets look one step ahead. They are forward-looking. They're looking at what the central bank is likely to do with this information, and that is probably to either cut less or be more reluctant to cut going forward. And so the currency, in that sense, is a little bit more attractive in relative terms on yield bearing grounds. And so the Canadian dollar manages to hold up better today than do the other majors. On the earnings front, obviously, there's a hodgepodge of reports here today, but the one that really seems to stand out is, of course, Netflix. And you can see why it isn't rocket science here. Once we look at the market cap, 552 billion, that's easily the biggest name on this entire list for today, and by a lot. So, I mean, the next one that's even comparable and is over 200 billion lighter is Coca-Cola, just to give you a sense of scale here. So, not surprisingly, this was the big story here as far as earnings goes, and it missed. And Netflix is down after hours for all that. We'll see if this gives indigestion to NASDAQ and the broader indexes tomorrow after essentially a non-event of a day today. The really big story on the earnings front coming up for Wednesday, of course, is going to be Tesla, another big tech name. And here you can clearly see, again, there's miles and miles between this 1.4 trillion market cap and everything else. So as this gorilla is going to go, so too it will influence everything else that follows. Thursday and Friday, things slow down considerably on the earnings front. We have, I suppose, something of an AI adjacent name in Intel, but not really a whole lot else that's at the scale of what we're talking about here. And the question really at this point seems to be how much of this stuff really matters. Because again, we're in this sort of strange environment now where we don't have economic data, at least until Friday, and we get that CPI report. Fed policy expectations appear to be anchored. We don't really have any guidance on why they should get unanchored this way or that. We still have this big disconnect here, and that's perhaps the biggest story of them all, that the markets clearly see much less inflation and a much more expansive Fed easing cycle for next year than the Fed itself has allowed. It thinks that we're going to have 3 cuts this year. The markets have priced that in already, of course. We already had September, and we just saw that December and October are fully discounted. For next year, the Fed only has 1 cut. And the markets clearly think that is not what's going to happen. So the question remains, why is it that the markets are so dovish, whereas the Fed is not? And when does this get some level of reconciling? Well, for now, it doesn't seem like it's in any kind of hurry to do that. And indeed, that we are getting a stronger US dollar here, even though the markets are this dovish, seems to suggest that maybe something else is going on. Here's what's happening with policy expectations here relative to stocks. We can see stocks have at the very least stopped rallying, even though these policy expectations are getting more dovish. And we've looked at this as something of a warning sign because, of course, if the markets can't rally on something that has been a feature of this advance going all the way back to May here, where once we kind of correct sentiment-wise from the sell-off that was the tariff spook at the onset of the year, and then, of course, Liberation Day right here, we can see once we come off these extremes, this is where the Fed outlook peters out. Not surprisingly, we can see that's exactly where stocks return to undo this breakdown right there. So essentially, we're back to the starting line here. And you can see from here onward, where you get more dovish expectation, you also get higher stock markets. That seems to have broken right here, where stocks are struggling even though policy expectations are growing more dovish. And that is perhaps one reason to be circumspect about just how far stocks can go here. The dollar, for its part, adding to this sense that maybe the Fed is on the back burner and things are moving for other reasons, or at the very least that the Fed is not the catalyst that it was before, because we can see here's your dovish adjustment in policy expectations, and the dollar is trending higher since the meeting in mid-September. So since the Fed actually issued this cut, the dollar is stronger, even though policy expectations have become more dovish. All of this perhaps hinting at capacity for risk aversion and for the dollar to reclaim its haven bid. So positioning-wise, I am still long it. Short the Aussie, short the pound, short the euro, short the Canadian dollar, to today's moves notwithstanding. I put on a little bit of an exposure on the bearish side of gold, but selling calls here, looking more for vol contraction after this huge move than anything else. I'm a little bit short Bitcoin after it broke its range last week via a put vertical, and a little bit short the Nasdaq and the S&P, looking for some of these dynamics to eventually give way. If it is risk aversion that's being signaled here, these might work. Still long the bonds, still short crude oil. Bonds working not so much today for crude oil, but ultimately it didn't go anywhere, so we will wait and see what happens next. And that is Macro Money for today. As ever, we are here right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, usually looking at the Wall Street close and where things may go therefrom. Also writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. Also now commenting on Reddit. So come check out my various thoughts there. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.